would say, though, the one thing is that we're constructive on U.S. equities. We believe that we're going to have that tailwind in the fourth quarter, but we can't discount international equities either. And so one thing that we found is when you look particularly at emerging market equities, everyone tends to view them as exactly the same. So it's this emerging market contagion. You get some negative news out of Turkey that we saw last month, and all of a sudden everyone's discounting names like, or regions like China and Brazil. And I know China, there's a lot of headline risk there, but that is actually a market where we've seen a substantial amount of innovation. You have a huge consumer base there. You're talking about a population of 4 billion people. Innovation, the consumer base, as well as the infrastructure spending that the Chinese government is committed to doing in the fourth quarter. I think there is a very interesting opportunity there.
You better buckle up, though, for more risk and volatility there, right? I mean, Jay Powell's going to have a press conference today, the Fed chair. Yeah. And he's going to talk about the fact that we're on path to more tightening.
But
no surprise. Don't like that.
No surprise.
Yes, but I think the market's going to be looking for an indication what he's going to do in December. I just think that's going to be incredibly important. Does he acknowledge, does he recognize what went on today at the United Nations with the president's comments as it related to the Chinese, the reaction from the Chinese?
He's not going to acknowledge that today.
He's not going to talk about that.
He has to acknowledge, he's specifically not going to obviously acknowledge the United Nations, but he has to acknowledge, and I think the committee will acknowledge in some capacity, what's going on with trade right now. Do they view trade as a growing headwind for the marketplace? And if they do, then maybe you don't get the December 25 basis points.
Given what, Mark, the economy's been doing, seems to be in a great place.
Yeah.
You want to look at one barometer at least, the stock market. We're at record highs.
Right. Well, look at...
there's no negative message in that.
No, take, for example, the semiconductor index. 90% of the revenues in that index come from overseas, and that index is up 9% year to date. So, I don't think that all these trade tensions are really holding us back as much as some investors do believe they are.
Yeah, but the negatives, which he might address or might not, are questions such as commodities, energy prices. You have Brent hitting 82, you have WTI at 73, 74. There's a certain point when you begin to feel pain if you're a consumer.
I'm just saying, if you're getting a nice jump in the industrial stocks, Chris, if you're finally getting some activity in the financials because of where rates are and where they may go from here, healthcare is doing well. It's not like tech has completely fallen out of bed. Okay, some things have assumed a leadership role. Why spend the pain and brain power looking elsewhere outside the U.S.?
I think the key point is actually looking at global diversification. And one of the things is our clients continue to ask the question, is everything too expensive? So when you look at the levels of U.S. equities and you look at some of these sectors, we still like them, don't get me wrong. We like tech, we like healthcare. Energy is actually an interesting one when you look at how energy stocks have actually lagged the rally in oil. That could be an interesting, very short-term tactical play in terms of adding some exposure. But in terms of building more resilient, globally diversified, and looking at these entry points for the longer term, I still think there's a really strong fundamental story in China. And Brazil, a lot of that sell-off is due to currency, and it's due to elections that are going to resolve in the next couple of weeks. And so with that, you're building a long position, just waiting for market certainty, and then benefiting from a rally on the back of that.